lose a lot. So I need to know how to stop losing all this money.
Okay, so you're profitable, but you lose a lot.
Right.
Normally, in what situation are you profitable?
When I trade by myself, but usually when I listen to other people, that's when I lose
You start
a lot.
losing. Okay. A lot of the times, it isn't that it's other people.
Mm-hmm.
It's that you your own bias ends up getting skewed by other people's opinions.
Right.
Um, give me one second. Okay, sorry. So like essentially, a lot of times your opinion ends up getting skewed by other people's vision, right? So a lot of times, like for example, depending on what you trade, you may see one thing, somebody else may see another. Maybe they give out their opinion, but they don't tell you that their TP is like they're scalping and that their TP is like 10 pips away, and then you get swayed off of your position just
Right.
because of that person's comment, right? For example, that's what Leslie does, and like Richard Wyckoff. Him, well, he's known by many names, but we call him Leslie. And he, a lot of times people will be like, oh, I want to sell this pair, and he'll tell you sell it. Or like he'll say, oh, I want to buy this pair, and he'll say buy it, add more lots. Or he'll be like, or you will literally tell him like, oh, I wanna like I went into this trade, right? Say I sold GU, and he said I just bought it. People know that he's a good trader, right? And when he says, "Oh, I bought this against you," you don't know if you're trade. You don't know if he's being serious or not.
Mm-hmm.
But he does this for a reason. He does this because you need to fortify your own sense of direction in the market. Because anywhere you look, your opinion can be swayed. So,
Right.
like for example, say if I go on Instagram and I look up hashtag NZDUSD, I will have a ton of different analysis from a ton of different people, half of them saying buy, half of them saying sell.
Mm-hmm.
And depending on what strategy you use, it may make sense. But the problem is, the problem is, how are you going to hold your own bias when everyone else is shoving their biases on you? Or like
Right.
Leslie is messing with your head, right? How are you going to do that? One thing that I do have to stress for you guys is proper lot sizes and proper risk management, because I am very, very proud that you made those, what was it, 10K?
Mm-hmm.
I'm very proud that you did that. But the trade could have just as easily gone the other way, and you would have lost that amount as well because your lot sizes were massive.
I lost a lot in Tesla, and my lot sizes were like pretty small, but
Yeah, well, how much do you consider pretty small?
probably really small for like a training account.
How much was it?
Point 35.
0.25?
I had a point 35 and I had a point 10.
Those are pretty large for Tesla. Tesla is like between Nasdaq and US 30. Well, you trade Tesla like you trade uh SPX. So those are pretty high lot sizes, right? And those pretty high lot sizes, at the end of the day, what's going to end up happening is if they reverse even a little bit, you're going to have a lot of trouble, right? So you saw how fast gold moved when you had those giant lot sizes on it.
Mm-hmm.
How fast did it move?
Gold is pretty volatile. Period. That's why that's the main pair that I trade.
And that's completely fine. But at the same time, you need to make sure that your lot sizes are consistent and that they can grow your account and not blow it, right? Because R&R is everything in trading. And what I mean by what R&R is everything in trading is because, like, for example, say you have a trader who trades like this, right? The purple is going to be our entry, this is going to be your stop loss, and this is going to be your take profit. And say your risk to reward is, let's say, 1, 2, 2.5. 2.5. I call it 2.5, right? 2.5 risk reward. What's going to end up happening? You have a 2.5 risk reward, right? Let's say, for example, RR. Your risk to reward is fine. It's not horrible. It's not negative. It's not 1-to-1, but it's not ideal, right? Because you're risking, let's say, 40 pips for about 90 pips, right? So let's say this is 40 and this is like 90 or 100 pips, right? This is fine, but you need to leverage your losses properly, right? Because at the end of the day, when you go into a trade, you should not be thinking, what can I gain? You should be thinking, what can I lose? Because if you don't think, what can I lose? You're going to end up screwing yourself, because if that trade by some miracle, hits your stop loss, you're going to need, your account is going to need to survive that hit and be able to bounce back from it quickly.
Okay.
Right? On the next trade. So here, let's say you have like a $10,000 account, right? What you would be doing there is you would be placing a smaller lot size, especially if this is, a more volatile pair like GU or something like that. Then you would be placing, say, like I don't know, like a 0.25, right? You'd be say you place a 0.25, you end up, say it hits your stop loss, right? You just lost 40 times, well, what is it, by 2.5 or something like that. I forgot what the multiplier actually is, but essentially your account has to be able to hold this 40 pip loss and not be at such a disadvantage that you can't pop the same lot size in the next trade and make your loss back and more. Right? That's the beauty of R&R, because say another trader like us, right, they end up saying, hey, nah, I'm gonna buy it right here. My stop loss is gonna be right here, and my take profit is gonna be up here. At the end of the day, this becomes a 1-to-20 R&R. Or whatever the case may be, right? A 1-to-20, 1-to-40, 1-to-50. I've seen 1-to-200 R&R, right? And those 1-to-200 R&R, if you're risking only 3-4 pips, what lot size are you going to put? A super high one, right?
Right.
Now, why would you place that super high one? Because you're not over leveraged. You're not, right? If your stop loss is right here and price decides to do that, you're not over leveraged. You're fine. Okay. But even if the market decides to hit your stop loss, what are you losing?
3 pips.
Compared to?
40.
40. Now, once you see that these 40 pips aren't as worth it as this, say, 3 pip stop loss, what's going to end up happening is you're going to end up looking for positions like these, right? You're not going to end up losing based on other people's opinions, because they don't know how to get stop losses like this. So unless you see somebody that has a stop loss that's beneath 25 pips, don't even listen. Why? Because there's no reason for them to. There's no reason for you to. The R&R isn't great. Unless it's, a larger, more pip volatile pair like GN, GA, that, like one move is like 20 pips, So the reason why I'm saying this is because you have to end up learning how to maximize your R&R, right, to be a lot more profitable. Not only will you have to maximize your R&R, you also have to manage your losses, right? How am I going to bounce back from this five trade loss that I just had, right? Say I just lost 5 trades in a row. Usually you don't do that if you trade with Wyckoff or Smart Money. You might lose, 2-3 trades a night and you'll win like 8-9. But at the same time, what if you do, right? Say the market just absolutely forgets how to trade. Right? It forgets how to move and it just spazzes out and you lose a couple trades.
I had a day like that.
You had a day like that, and what ended up happening that day?
I lost, hold on, let me look in history, but it was probably like 7 trades in a row, if that.
So you lost around 7 trades in a row. And what if you were risking a lot on those trades, or if their stop losses were large? You ran the risk of blowing your whole account, right?
Mm-hmm.
Because say that trader that you're getting it from, or say you set your own stop loss at around 40 pips, and then you still pop like a 0.75 or something like that.
7, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. It was 13 trades in a row.
It was
But
13 trades in a row. At
these
what
are
lot sizes?
I never trade.
At what
Um,
lot sizes?
lot sizes were pretty low, like 0.15, 0.11.
And what was the account size?
Um, at the time, it was probably at 6K.
6K. Okay. Um, that's not bad. Yeah, that's not bad. That's pretty fun. That's fine. So you were leveraged properly for the most part, and you had a losing streak, which is
Mhm.
completely fine, and it's something that happens in trading. But at the same time, it shouldn't happen at that large of a scale, should it?
No.
So there's something evidently wrong that's going on, or maybe there's something wrong in your analysis. Like for example, I had a week where I did not hit a single take profit. And I was so mad at myself, and I was like, why? Like, I only sent out like 5, 6 trades, but those 5, 6 trades did not hit. And I was just like, why? Why? There's something fundamentally wrong with this. And I took a step back and I started rereading my notes. I started going over simple concepts again. I started going over simple market structure, stuff like that. And then from there, I ended up regaining my edge, right? That
Mhm.
happened like 2 weeks ago, right? And that's completely fine. But you have to analyze the way that you trade, and you have to ask yourself, is this trading style maximizing my risk to reward, and is it making it possible for me to achieve profit without having to risk much more than pennies, right?
Mhm.
So now here's your turn to tell me, right? What is it that you trade? Like, how do you trade?
I don't know how to describe it.
Okay, you
Like,
don't know how to describe it.
as I said, I mainly trade gold because I'm mainly profitable in gold. Like when I start to step outside of gold, that's when everything goes bad for me.
Okay, and when you're in gold?
I'm probably 80% profitable.
So then what do you think you do in gold that you don't do in other pairs?
Usually the other pairs are other people's analysis.
Okay, so there are other people's analysis. What if you took a look at one of those charts and you fundamentally understood why the market moved in that direction?
I've never done that.
That would help you a lot, right?
Right.
That would help because then now you understand why the market does something, or
Mm-hmm.
why it decides to, for example, why the market decided to reverse at that point compared to like a lower pattern or whatever, right? You will be able to decipher those things if you take a moment and you start looking at the whys, right? So, for example, say I lose a trade,
Mm-hmm.
and let's go to my screen. Let's go to my screen. Oh, wait, whoops. Where are you guys? Okay, give me 1 second. The chat just opened. I wish I was that profitable in gold. Yeah, man. So let's go to TradingView, and let's say I pick a pair.
Gold.
Well, lucky for you, we had to go far and wide to find that one. So let's say that I take a sell right here, right? Let's use the replay feature. And let's say I take a sell right here because I see an inefficiency or whatever, and I'm like, okay, I'm going to try to sell into that inefficiency.
Are you guys seeing his Google Drive or are you guys seeing TradingView? Because I'm
Oh,
seeing.
whoops. My fault.
Okay, that's
Are you guys seeing that now? Better?
better. Okay. Yes.
Okay. What is that? Oh, shoot. All right. Cool. What does the chat not work? Okay. Cool. So let's say I take a sell position right here, right?
Mm-hmm.
I put my stop loss behind this and whatever, right? Let's just say I do this because I'm a retail trader and I don't know what I'm doing, right?
Okay.
Or let's just say, or actually, you know what? Let's come up with a better analogy.
That's another
Let's
thing.
say, huh?
I do fibs.
What?
I don't know how to do fibs.
That's fine. That's fine. We can get into that later. But let's say, for example, right now, I don't know exactly how market structure works.
Mm-hmm.
I know, the basics, and I want my mentor to show me what's going on, right?
Okay.
Let's say I take this sell here.
Mm-hmm.
But we're deep in profit, right? We're deep in profit.
Mm-hmm.
But what just happened here?
A wig.
A wick, right? A wick. Not only that, but it slapped my stop loss before it actually hit my take profit.
That's another thing that I hate. I tend to not use stop losses because it's usually that one bitch ass wick that comes, haha, I'm gonna say hi, but I'm not gonna stay long, and then goes into profit. I don't like that.
Yeah, but the thing is that a stop loss is something that you should be using because even and this is also one of those big misconceptions that need to be clarified. At the end of the day, your stop loss exists for a reason.
Mm-hmm.
Not only does your stop loss exist for a reason, you also need to learn how to use it, right? Because if you have a 40 pip stop and it goes up and it taps your stop and it comes back into profit, there is no reason for you to have had a 40 pip stop at that point.
Mm-hmm.
There's no reason for you to have had one. Absolutely none, right? Now, let's say that you have a 4 or 5 pip stop loss and it gets hit. Okay, you're out of the market until the market makes its move, which in this case could have saved you a ton of pips,
Okay.
right? So right here it wicks up, but then what are we actually wicking up into? That's the question. What are we actually wicking up into? So we end up wicking up to right here. What are we wicking up into? OB? I don't see an OB there. Personally, I don't see an OB. An OB would be up here.
Mm-hmm.
An OB is an order block, by the way, too. Let's go another 20 minute and see what happened. Well, there's something very interesting going on here because it's actually an inefficiency. Let's disconnect this right here, and then let's disconnect this right here. Actually, it could be right there. Yep, right there, right? This right here is an inefficiency. By the way, whoever is having their... Oh, it's Chewy. Okay. Makes me sound like I'm from the Robots movie. So right here, we actually end up wicking into an inefficiency, right? Because right here we have a naked candle that hasn't been mitigated by everything on a big power move, right? On a big power move down. We have this liquidity right here that needs to get grabbed. Okay, we have that liquidity right there. We have this liquidity right here that needs to get grabbed. And we have this liquidity right here that needs to get grabbed. Right? And all of these ended up getting grabbed. Grabbed right here. Grabbed right here. and grabbed right here. Make sense?
Right.
All of these got taken out, right? And not only that, but this becomes our sign of strength, right? This becomes our sign of strength. And now we see that it wicked right into the 20-minute time frame inefficiency. Why? Because the inefficiency is from here where the wick touches to over here where the wick connects, right here. That has already been mitigated. Now, let's say we draw a little rectangle around it. And then we use the 50%, right? Because the theory of fair value gaps and stuff like that essentially says that you want to aim for the 50%. Does that make sense?
Yeah.
Right, so let's say we aim for the 50%. Surprisingly, our 50% is right here. Literally right at the wick, right? Let's say we place our entry a little bit lower to account for spread. Boom. Now we have our setup, right? Now what ends up happening? What ends up happening is that our setup gets wicked, triggered, and comes down. Now let's say we're a smart trader and we see this position up here and we want to catch it as best as possible. What are we going to do? We're going to put a sell limit there with a stop loss of about what, 4 pips? And then what's going to be our target? What area of interest do you guys see in this position?
Why am I the only one looking?
I would say the last, like the lowest candle over here, like the sort of, it's like the lowest low that is
This one right
visible here. Yes.
Yeah. So right here, you see the order block, right? And the order block actually ends up opening right here. So it wicks the open of the order block and then buys back up. So let's say we mark our order block, right? And our order block actually ends up getting wicked. And now, right now from there, that would be our take profit, because then at that point, we would be expecting a reversal from that fair value gap, right? So what do we see here? What do we see? What is this? We see a very, very
Liquidity.
high risk to reward ratio. It's a 1:16 risk to reward ratio. Let's say you pop a 0.25 on gold. Y'all know how much that pays. You're risking what, $20? For a lot more money. Right? Do you guys see the importance of risk to reward ratios? So risk to reward ratio at the end of the day is going to be the king of your trading. You need to learn how to master it, and you need to learn how to put it together. You need to learn how to put it piece by piece. Now, this demonstration wasn't to get you to know what a fair value gap or an order block is. It was to show you how R&R has such a big impact on you as a trader, right? So say you have that 10K account, right, that you had. You need to be minimizing your risk and maximizing your reward. How would you do that based on what I just told you guys, on what I just showed you?
Much sense.
How would you guys actually end up minimizing your risk?
Smaller stop losses.
Yeah, but not only smaller stop losses, right? You have to place your stop loss where it makes sense. So yeah, you're right. Smaller stop loss, but you have to place that smaller stop loss somewhere that makes sense.
I
Right.
told my this week to recovery because I haven't traded since that loss. Like I was like over it. But I deposited today and I entered one trade and I said I was gonna use a stop loss. I told myself I was gonna use a stop loss. And then Nas like dove down. And then usually it just I was just kidding and then went back up and hit my TP. But going forward, I'm gonna use a stop loss.
And it would usually be better to use a stop loss, right? It's not necessarily a bad thing. It's not horrible to use a stop loss. What you need to be doing with a stop loss is you need to be getting out of the action if it's not going on your way, and then maybe later looking for that reentry, right?
That's
So
an issue of mine. I will literally watch a trade go bad and just be like, huh, if it blows, it blows. And it did.
well, what are you changing by staring at the chart?
I don't know because hopefully
Does it make you feel better?
no.
It
I'm
makes you
usually
feel worse.
I'm usually hoping for a reversal. Sometimes it reverses, sometimes it doesn't. Most of
Right. So one of the biggest downfalls of any trader is that emotion. Well, is their emotion, right? But not only any emotion, it's hope. Hope is one of the strongest and most terrifying emotions to have. Why do you think I say that?
because you have hope that you're gonna make your money back.
You have hope that that trade's going to go your way. You have hope that this loss won't be as big if it just comes back up to your entry.
Mm-hmm.
You have hope that this is going to be your last over leverage. That you're going to make your losses back on this trade. Oh, I trust this person. Their trades usually hit TP. I'm going to over leverage. Hope, right? You shouldn't hope anything. This isn't a gambling market.
Right.
This is something that you need to be precise and intelligent about, right? So in this situation, I analyzed this position and I said, I see a fair value gap. I see 3 points of liquidity that need to be taken out. So I'm going to be expecting a push either to up here or to up here. I'm going to set one limit right there. Boom. My stop loss above it once it filled the inefficiency. So if I get hit, if I get stopped out, I get stopped out. No big deal. But then I have another position right here that I say, okay, no problem. If I get stopped out there, then hey, I will just catch it up here. Because if I catch it up here, then I will be able to re-enter the trade with another position with an equally small stop loss and a bit larger of a take profit. The good thing about trading with good R&R is the fact that you will end up cutting your losers early, right? You'll hear a lot of traders say, oh, professional traders cut their losses early. Well, how do you know it's a loss? Well, you might not know, but your stop loss knows, right? And using that stop loss to your advantage, it's not your enemy, it's your friend. You just have to know how to command your friend. You have to know how to use it. Because if you can't use it, it won't help you. For example, if you keep placing your trades without a stop loss, one of these days, what do you think the market's going to do to you? It's going to take your account again, right?
Yeah.
And if it takes your account again, then, oh well, what can you do? However, what you're going to be focusing on now is you're going to be focusing on becoming very precise with your trades. You're going to focus on making sure that you wield your stop loss correctly. Okay? So here's my suggestion. My suggestion is to look a little bit further than gold. Go to the minor crosses, meaning AUD, NZD, HF, NZD CAD, NZD JPY, stuff like that. Those are very good practice. Those are very good practice because they follow price action strictly, and they're very easy to see as a beginner where price is going to go, especially if you're learning smart money, right? For example, say you as a trader see an order block right on one of these pairs. You'd be more likely to spot it there, and thus you're going to be growing and kind of refining your expertise with those trades until the point where you can see it even in a topic climate. For
Mhm.
example, you really wouldn't be able to see this inefficiency unless you zoomed into it. How did I know there was going to be an inefficiency? Well, I suspected it as soon as I saw this. As soon as I saw this giant movement down, I
Mhm.
suspected something. I suspected an inefficiency. I suspected a a fair value gap, whatever the case may be. I suspected something around the 50%, because I said there's no way this candle wasn't mitigated, right? And it wasn't mitigated, not up until 50% of it. And then this candle went up, wicked the 50% and dropped. I don't know what actually ended up happening to gold, but well, the sell TP got hit. Right, the sell TP got hit, and then it bounced straight off of our order block. And what did it end up doing? It ended up buying, right to where our buy TP would have been. Right, so it wicked our order block. Small stop losses. Wield your stop loss correctly. How are you wielding your stop loss correctly in this position? Does the stop loss make sense to go behind the wicks? No, because there's liquidity behind this. Sorry, is it wise to put your stop loss at candle closure? No, it's not. Why is it not? Because of the fact that there is liquidity in those candles. And since there's liquidity in those candles, you genuinely do not want to get caught off guard by it. So you want to put it a little bit below that wick on an order block. Now, what ends up happening? The 50% of the order block ends up getting hit, triggered, and goes into a little bit of drawdown on a total drawdown of, what is that, 12 pips? Very low, right? And then it shoots off for what? For 50 pips, we could say, a couple, I don't really know how to read this ruler, but it should be like, like 50 something points, right?
Mhm.
Now, when you see this, and when you see how I caught both plays,
Mhm.
what crosses your mind? Like, what are you thinking? Or like, or are you having problems like grasping a certain concept?
I'm having a problem grasping a lot.
Okay, like what?
Order blocks, fair value gap, all of that.
Okay, so kind of like the specialized terminology.
Right.
Okay, sure. I have a video on order blocks and liquidity. If you want to watch it, it's on my YouTube. It is the latest video that we've watched, that we've uploaded.
Okay.
Yeah, that one can help you a lot out with order blocks.
Okay.
Yeah. But essentially, what you want to aim for here, and what I was really going for, is that you have to learn how to be precise, and you have to learn how to be very consistent, right? Because say you want to have a normal day, that's fine. Get into, like, start trading at around Asia, Tokyo. You can end up trading from around, say, 10 to 2, going to sleep, waking up at 7:30 to around 11, and trading that. And from there, you won't have to be glued to your screen at all times. You'll be able to do other things, right?
Mhm.
So this is the moment where I want everybody else in the audience, if they have any questions, to please ask them.
Y'all could unmute yourself.
Yeah, you can unmute yourselves.
So,
When you're looking for order blocks, you look
somebody saying something?
No, go ahead.
you hear me, bro?
Yeah.
Okay,
I'll
somebody.
go. I'll go if no one's going.
Okay. I was saying. So what should we start with once we have that basic thing? What should we learn, like in an order or something else to like slowly develop our skills? What concept should we focus on?
Can you repeat that one more time?
What are like some of the more important concepts we can focus on in building our skills up?
So essentially, you want to learn liquidity, right? Because liquidity ends up being the name of the game in the more advanced techniques. For example, say you're at the level that me and Wyatt are at, right? We can look at a chart and without even marking it, we can tell you the general area where price is going to go to. Now, does that mean we get in? No. We know that price is going to that direction. We don't know when, how, or how violently. Right? Sometimes certain trades aren't worth it. Now, the one things that you do need to learn are liquidity. And I want you guys to write these down. They're going to be liquidity, order blocks, and structure. Independent structure, which is a concept that I'm actually working on proving at the moment. And essentially, it's every day has a different structure, right? For example, yesterday's structure on GU won't be the same as 2 weeks ago. It won't be the same as yesterday. It won't be the same as 2 nights ago. It won't be the same as last week's. It has a different structure because there's a different daily candle, right? And since there's that different daily candle, there has to be different structure. Example, let's go ahead and clear this and let's take a look at this. Every single one of these candles represents a series of 24 hours, correct? However, every single time that these 24-hour candles go ahead and end up closing, you have to end up thinking, where is structure most likely going to push price toward? Right? So gold isn't a very good example of this because it ends up being very monotonous and it only goes up. Let me see, what's another pair that you guys like that isn't gold or an indices?
GJ.
GJ.
Yeah. GK.
I personally used to hate GBP/JPY until I
used to hate it. Yeah.
until I realized that it was really just a GU that is on crack.
Yeah, that's mostly GBP pairs.
But I will show you a trick to the GBP pairs. So for example, we have daily structure here. We have daily structure, and not only do we have daily structure, we also have volume. Actually, volume is a different concept that I won't show you today. But essentially, we end up saying, okay, where is the daily point? This candle, this next candle, right, that starts at 5, it's either going to go up, right, and come back and fill this wick, or it's going to continue down and continue rejecting this daily low, right? This is what I'm calling this theory. So essentially, if we look down on lower time frames, let's say we go to the 1 hour, we're going to see that this was a clean distribution. This was a clean distribution that actually never went back and filled itself. For me, it never went back and filled itself. It created this, this updraw. Sorry, it created this It created a little bit of distribution. And if we look down on the 10-minute, we could probably see it a lot more clearly. Yeah, so right here, it ended up creating this distribution, right? So it created this upthrust. It created the upthrust again, right? And it mitigated itself again, and continued dropping. So my area of interest would have been around this area. Once it was mitigated once, I would have actually checked for this to be mitigated one more time. So this right here became my area of interest, right? But this is not on the same daily candle that we're at right now. Does that make sense?
Mm-hmm.
Are you sure?
Mm-hmm.
That ended up being, where was it? That was up here. Right, and let's say we like kind of expand this to make it a little bit bigger just so we see it on the daily. And let's go back to the daily. That was up here. This daily structure was up here on the wick. Now, if we see it on the wick, right? This daily structure obviously had to push down because of the distribution that was correlated later. Now, let's say that this structure, so one thing that I do want you guys to understand is that price is fractal. You guys know what fractal price means?
No. Also, someone's mic is messing up. Is that just me or like?
Not sure, bro.
So, guess it's just me then.
Yeah, I'm not sure.
No, but
dang,
I'm not
I
sure
didn't
what
realize.
fractals are.
Here, I didn't realize that you guys had been typing in the chat. So I've been getting my tail whipped because of it. I just want to be taking trades. Okay. Smaller sell, big TPs. How did you catch them? What did you see? When are you looking for order blocks? Your time frame. Zai, is this better now? Is the mic better now?
No, it's still kind of cracky.
Mine?
Yeah.
That better?
I don't know. You haven't used it long enough for me to say that, but I mean,
Okay.
I guess.
Let's try it. Let's see if and interrupt me if it is.
Yeah, I got you.
So where do I look for order blocks? Do I start on higher time frames? Yeah, you should always look for higher time frames. And the reason why you should be looking for higher time frames is, how do you know that this right here isn't, say, a schematic? What you don't realize is that this is a schematic. What schematic, what Wyckoff schematic is this? Specifically right here.
Accumulation? Or are you talking about like the range stuff where it has like all the symbols and stuff?
Yeah, that's Wyckoff.
I couldn't tell you.
So this right here, there's something that I'm calling hierarchy of price. Okay? And no, it's distribution.
I didn't say it, but I was thinking it. I wasn't quite sure.
Yeah, so you're right. It is distribution. Why? Because you have an upthrust that was mitigated, and then this upthrust was mitigated by its own order block. Right? So right here, usually I'm trying to simplify Wyckoff into a point where you don't have to mark it up. You just kind of have to see where price is going to. So this area right here would have been your area of interest to enter, right? Now, this upthrust was mitigated by this last point of supply, right? Or sorry, this test, you could say. And then the last points of supply ended up coming over. Now, this last point of supply would have been sniped off of this weekly order block, right? You connect the wicks, boom, weekly order block just got sniped, right? We go at it again from this angle, from the daily chart. And again, it would have been almost the exact same thing. If we fib it from, press Alt F, from the swing high to the swing low because it's in a downtrend, you would have hit your 886 or your 79, right? This is your kill zone. The perfect kill zone becomes your 886 and your 79, right? And this kill zone right here ends up getting hit about halfway, right? Now, what do you do if you don't see a specific area of interest here? You go lower. What is over here? Is there something over here? Well, there's a breaker, right? There's a small breaker right there. Let's look at it from the 4-hour perspective and see if we see anything. See, now here is something that I am looking for. I'm looking for this break in price right here. This break in price before the dip is what I was looking for. Now let's go back over and see if it would have missed. Nope, would have gotten sniped. Now let's say we go down to my favorite time frame, the 10-minute. What would we have seen?
I got a question.
Go ahead.
So you're telling me at that point where it broke price at the order block, I'm pretty sure that's what it is. That would be the specific like structure you'd want to like snipe it off of.
Which one? The daily?
The daily, yeah. That yellow line, yeah. Where
This
you
yellow
wanted
line.
price to,
Yeah.
Where
Yeah.
you wanted price to break off. That specific structure on that order block.
That would have been my area of interest. So I would have been looking for confirmation inside of that area of interest. For two
because
reasons.
that's the kill zone?
Yeah,
in
not
the
only
fib?
is that the fib kill zone, but I also know that this was the previous high to a last point of supply, which was proven by our weekly time frame. Our weekly
So,
time frame showed distribution, right? Which means what? Going down, correct?
yeah.
Right? It means essentially going down. Now, since we know that, since we know that, but we also know that distribution doesn't just do this, it ends up doing, right? Because the market likes extremes. It loves extremes, okay? And because it loves extremes, you're going to see it test as extremes again, or as I call it, purging highs or purging lows. Purging extremes is essentially what you call it. So what I was saying earlier is that price is fractal. What is this fractal theory? Essentially, price will show the exact same picture, if not in more detail, on the 5-minute, on the 10-minute, on the 15-minute, on the 5-hour, on the 4-hour, on the 6-hour, on the 2-day, on the 5-day, on the 20-day, whatever time frame you're looking at, the lower time frames are going to feed into it. So you will see a reaction on a lower time frame before you ever do on a higher one. Higher time frames are good to see the general direction, but they're not good for entries. Now, I used to be the type of person that would religiously use the 4-hour and the 1-hour, but I wouldn't be able to see jack shit. Now, the reason for that is because you will never see it on the 4-hour. There's not enough candles for you to do it. But you will see it on lower time frames if you go off a higher time frame structure. So let's end up saying, right, let's end up saying that we ended up seeing this position and we saw, hey, this is my area of interest right here. Since this is my area of interest, I'm going to be looking for a reaction. If we never would have gotten that reaction, what would have happened? What would we have done? If we would have never seen distribution on the 3-minute, on the 10-minute, what would we have done?
Wouldn't have took the trade.
You wouldn't have taken the trade because you don't have that confirmation. A lot of people wait for 7 different confirmations on 20 different indicators and for the stars to align for you to take a trade. That's ridiculous because you're never going to actually take that trade. And if you do take that trade, you've already missed 30, 40 pips. Doesn't make sense, does it? Since it doesn't make sense, what are you going to end up doing? You're going to end up looking for a You're going to end up looking for a position where you, as a trader, will have enough confirmation for you to even consider that trade. Right? In this position, we know that until we see a reaction off of this, or until we see an equal and opposite reaction, meaning that we see accumulation to this, we are not going to stop falling. So what is our position so far? Our position right now is bearish. And you would have caught that off of the daily, right? Because of, first off, our kill zone right here, right? And you saw, what did you see? You ended up seeing, say you checked the 5-minute on the opening of that week, and you would have said, okay, let me analyze and look at this. All right. And let's see what time it actually happened. 7:40 p.m., 8 o'clock, 8:30. You guys know that I start looking at charts around 8:30. 8:30 p.m. to 10 p.m. and then from around 2 to around 3:30. Now this Asia kill zone, what ends up happening here? This 8:30 kill zone, 8:30 right here. I would have gotten on the charts right here. Whoops. I would have gotten on the charts right there. Right at this point, at this candle opening. What would I have seen? Well, I would have waited for some type of distribution. What ends up happening? It ends up dropping, ends up reacting, right? It ends up dropping, reacting, dropping again. At this break of structure, I would have said, okay, let's fib it from up here. And then let's look for a reaction. What ends up happening? What ends up getting hit?
Goes to the kill zone, 70%.
Goes to the 79%.
79%, yeah.
Right, it ends up going to the 79%. Now it ends up going to the 79, and what would have been our position in this case? Our position would have been short, right? Right at the 79. Calculate for spread, so a little bit lower. Your stop could have been at the 1.1. I would have put mine at the 1 because if it holds this high, you know that this is a true UTAD or upthrust, right? It would have been a true upthrust or true change of position is what I'm going to call it. A true change of trend or position, right? And your first take profit would have been at the 0, but we don't aim for lower pips. So we're going to go all the way to our 2. And what would have been our risk reward? Our risk reward ends up being 1 to 15. 8 pip stop loss, right? For a very, very nice take profit. Now, not only that, but if you would have gone off of your structure and you would have said, hey, if it breaks this candle, it's not a true high, you could have actually lowered your stop loss to around 4 pips, and you could have gotten a 1 to 27 risk reward. Now, that, of course, takes a lot more monitoring, but it would have been something that I could have done, that you could have done hypothetically. All on lower time frames because you understand higher time frame confluence. So essentially, when you understand higher time frame confluence and then use the lower time frames to actually identify your entry point, you're going to end up catching entries like these, in which you have an 8 pip stop loss for a 122 pip TP. And what happens? It actually ends up getting hit twice. Gets hit again.
So that's how you would use the Fibonacci, pretty much.
Yeah. This is how I was taught to use it, and that is how I continue to use it. I don't take credit for that Fibonacci position.
So pretty much while using Wyckoff, we would use the 79% to 86%.
88%.
Is it
88.6.
Yeah. 88.6. Yeah.
So let's recap this trade. Essentially, we looked at the weekly, and we said, what do we see on the weekly? Is there anything interesting on the weekly? Is there even anything relevant on the weekly? Is there something that we need to have on the weekly? And what did we actually end up seeing?
Your weekly screen is not loaded.
Yeah, I know. It's like it's bugging out. Give it 1 second.
Gotcha.
But from what we remember, what did we see on the weekly screen?
We saw a distribution.
You saw distribution. Now you saw it also start to come back up to its upthrust after to its last point of supply. What ended up happening at that point?
The high was used as resistance, or pretty much.
The high was used as an order block, right?
Yeah.
The high was used as a point of structure, right? That's what I'm going to call them from now on. Point of structure. You also saw this sign of weakness. This sign of weakness should have said to you, hey, price kind of wants to go back there, right? Price wants to go back there. Why does price want to go back there? Because price usually wants to fill itself in. Prices are a lot like cells, right? So in biology, you're taught that a cell wants to maintain equilibrium, right? Because if there's too much water, it expels water from its system to try to keep itself in balance. It's the exact same thing with price. Banks are going to try to keep themselves in balances, right? Because at this point right here, they let go of too many positions very quickly. So I explained this in my bank logic video, right? So for price to go up, there has to be people selling, right? So since there has to be people selling, what are we going to look for? Right? They have to come back and mitigate these positions, but they also have to be buying at these positions. If they buy right here and they drop, they rise price again so that they can mitigate these losses very low, and these buys now become short entries.
Sells, yeah.
And now they've mitigated their losses at a minimum loss. And now they're entering sells at a higher position, which is why you see these giant impulse candles, because a lot of other people that don't know how to trade, they're still selling. Or other bigger major funds that literally their only purpose is to lose for the banks, they're hedging this position, right? So what do we see right here? We see an inefficiency. We see this candle absolutely getting violated. What happens? Price returns to an extreme. Price returns to an extreme. Right, again, it returns to an extreme and then it drops back again. Now, some people would consider this an order block, but what they don't see is that it was already mitigated. This was already mitigated, so it doesn't really count, right? So now you filled in this wick, cool, but you also completed the distribution schematic. So once it does this, you know it has to return to extreme. Once it starts making its way up, you aren't fooled by this. You know it has to return to extreme, which means boom, you could have cut your entry up here. Let's say we use the replay tool and go back here and say, hey, what do we see in this position? Let's go to the 4 hour. What do we see right here that could have possibly said, hey, we may be in for a nice position? What do we see right here? Do we see anything? Yes, we do. We see a break in price, right? We see this break in price. Since you see this break in price, you immediately start thinking, well, let's see how price reacts here. Let's look at, our lower time frame confirmation.
Breaks price, comes back to it. Looks like it might bounce off.
Never actually gave us an entry. Since it never actually gave us an entry, what are we going to do? We're not going to trade it. Not yet.
Yeah, not yet.
Ooh, and you just missed out on what? A giant explosion in price. Now, this giant explosion in price never gave you an entry for short right there. A lot of people would have been selling it, but you wouldn't have. Why wouldn't have you been selling it? Because price never actually gave you that entry. It never gave you a safe confirmation. Now let's see what actually happened up here that caused this reaction.
Is AJ volatile?
Not really. Well, yeah, but CHF JPY is a lot more volatile. So we see liquidity that wasn't taken up here. We see liquidity that wasn't taken up here. It essentially, like I said, returned to extreme. This right here was the extreme point, right? And since it's returned to this extreme, we couldn't have predicted that, but we know that from here, it should sell off. Why should it sell off?
Because they returned to the extreme.
It returned to the extreme, and what do we see on weekly structure?
It's in distribution.
It's in distribution. So could you have predicted that? No. Do you want to predict it? Not all the time. React to it instead of predicting it. So you reacted to it, and now you said, oh, okay. Well, I know it's in distribution. It already cleared its extreme. It would be a safe sell, and you probably would have gotten it from somewhere on the top. What ends up happening? Now, what do you think banks actually return to this extreme up there?
You said, why do you think they do that?
Yeah, why do you think they return to that?
To mitigate their losses.
Based off of the laws of supply and demand that I just gave you guys.
To mitigate their losses.
To mitigate their losses and also add different positions.
Add different positions, yeah.
Right? So when you end up looking at this, what do you end up seeing? You know that banks have positions right here since of this consolidation. You know they have positions there for both a buy and sell. They took their profit off most of their sells here. That's why price skyrocketed. But they still have the buys up here, right? That they need to mitigate their losses for. They wick it real quick. They close in, a little bit of profit or at break even, and boom, they pop in some more sells. They have to pop in a lot of buys too, but they pop in a lot more sells, right? Again, their risk to reward is everything. They're only popping, say, 200 million lots in buys. And they're popping, say, how much did I say? 200 million lots? Let's say they pop 800 million lots, 3 times on sells. They're not crashing the market, but they're moving it in their direction. Now we see consolidation here, completely fine. We know that price wants to return to this area at some point because this has just been created as a new extreme. We have liquidity up here, which we should keep in mind, but we shouldn't basically break the rule book for. Speed this up a little bit. Cool. Now we see this position ending up right here. We have multiple inefficiencies. When we see these
Yeah, it
multiple
looks like a few
inefficiencies,
imbalances.
right, these imbalances need to be filled, right? Price likes to return to origin, which means, cool, we want to return it to origin. But at the same time, we also need price to end up giving us a position, right? So it ended up going down, breaking its low, completely fine. That's what distribution does, right? Now it ends up coming back up to fill these imbalances. Now it comes back up to fill these imbalances. And once we see this pivot in price, where should we be targeting?
78%. Or wait, isn't it 70, 79%?
It's 79 to 886. But more importantly than that, that's just an added confluence. What we should be looking at is we should be looking at our extremes. Right?
Right. Use that high as a structure point.
Use that high as a structure point, correct.
That's why I see it making lower highs when it usually does a burst back down. Makes a little more sense now.
Now keep in mind, we're trading off the weekly time frame. We're not going to get moves every single day. But that's also why you trade lower time frames and you trade daily structure, but that's for another lesson. I'm trying to teach you guys how to look at price and say, look at how extremes come into play. And I'm also giving you guys a little bit of easier plays by giving you the fib levels that you need. Speed this up a little bit. Now it comes back, and this is where we are right now. We end up wicking our zone, and we end up giving ourselves an entry. Why do we consider this an entry? Well, because on the lower time frames, what ended up happening on the lower time frames, what we ended up, like when we actually started looking at our position. When we actually ended up starting looking at our position, we saw this reaction, then we saw its retrace coming back to extremes, and that would have been our entry, this extreme. Does that make sense?
Yeah.
Q, does this make sense to you?
Yeah,
Are you sure?
I'm lying.
Okay. Where am I losing you?
I think it's all the lines. It's just confusing.
So listen, you don't need to even have these lines here. They're just for me to reference where price was and is. They're kind of like landmarks, right? You don't need them. They don't mean anything.
Okay.
They only meant the date. Like I was looking at what time it was, and I was looking at where price was in the past, right? That's really all. I was just using them as a point of reference. They don't mean anything.
Okay.
So let's say, right, that we look at the daily, at the weekly, sorry, and we see this distribution schematic. Later, I can teach you what distribution looks like, right? But let's just say a downtrend. Let's keep it simple, a downtrend. I just taught you a theory, right, that has been proven that price likes to return to extremes. Since price likes to return to extremes, what ends up happening here? Where should our target be? At around extremes, right? Now, using our fib, do you know how to use your fib?
I told you I don't know how to use fib.
Oh, my fault. So essentially what you want to end up doing is your fib will look something like this, right? Your settings will look something like this. How you use your fib is very simple. You end up taking your fib, right? And you say, like, say there's a structural high and there's a structural low. Say there's a high right here and there's a low right here. And let's say price is moving in this direction, right? It's starting to move down, right? Price has returned, it failed to make a higher high. Let's say it does something like this, right? You end up placing your fib from the high, right? You end up placing your high from the high all the way to the low,
Makes
right
sense.
there, right? And that high, the position that you end up wanting to look for will be between your 886 and your 79. Usually it'll wick the 79 or it'll go deeper, right? But if it's true, it won't go past the 886, but your stop losses just for safety purpose are at the 1. If it's a true position, it will never go past the 1, right? So this is the area where you would like to hunt, right? This is where you're going to aim your scope, but your eyes are going to be focused around where price was right here, what it did right there, and how it could possibly affect price right here. Does that make sense?
Mm-hmm.
So do you want these levels, by the way?
Sure. Let me go to.
So you guys can take a screenshot of my levels.
Wait, that's not on the default fib?
No.
Oh boy. Okay, gotcha.
So just take a screenshot really quickly.
Yeah, got you.
Yo, James, could you go back to to I think it was you're on it right now, the week. So you notice how you pointed out distribution, and then you said that candle after you exit distribution and it mitigates to the bottom, that's not considered an order block. Why is that?
Which one? Oh, that was right here. Yeah.
Yeah.
So it's not considered an order block out here. The reason for that is very simple. It's because one, you usually don't want to look for bullish order blocks if you're in a downtrend or after distribution. Usually that doesn't work,
Okay.
right? Second off, it was already mitigated here.
I see what you're saying. Okay.
You see how this order block launches off and then mitigates itself?
Okay, that makes sense.
Sometimes order blocks mitigate themselves. That's why I didn't want to take the trade off of this right here. I wanted to take it off of this right here because this order block mitigated itself and dropped.
Oh, so that's
There's no reason for banks to come back here. Could they? Yeah, if they want to in the future, but there's not necessarily anything there left. This mitigated this. So this no longer needs to be mitigated because this was already mitigated by this candle right here.
Oh, okay. So you're saying that previous move that you didn't want to look at, that order block, that mitigated that previous extreme.
Yes.
And then that where you have the zone right now, that mitigated the previous order block, and that was an indication to look for.
Essentially, yep.
Okay.
Yep.
Okay.
So you're telling me all of this is just price mitigating price for other entries?
Yes. That's exactly what trading is.
All right.
That makes sense.
Makes a lot more sense.
That's literally exactly what it is. Like I couldn't have said it better. It's a game of liquidity trying to mitigate itself. It's literally just liquidity trying to mitigate itself and mitigate itself again, mitigate itself again, mitigate itself again, mitigate itself again. All it is. Does that make a little bit more sense, Q?
Yeah.
Are you sure? Don't lie to me.
Yes.
Okay. Positive.
Extremely.
Are you sure?
Yeah.
Okay. So that's essentially what I wanted to show you guys today. I wanted to show you guys the theory of market extremes, and I also wanted to show you guys how basic market structure can take you a very, very long way. And that's something that I want you guys to focus on. Now, a lot of you guys have been, some of you guys have been asking me for like what I'm going to be doing in these coming months. I'm going to be teaching this, and I'm going to be studying it a lot. Want to take your own study time and try to study a lot of these resources. I'll send these to you guys personally later on down the road, so that you guys can take a look at them. But what I want you guys to look and see is I want you guys to see how on the higher time frames, you will see certain moves and then use the replay feature on your trading view and go into there and zoom in and see why price rejected off of where it did. Or what would I have done in that situation?
All right. One more question.
Mhm.
So you could tell this was a distribution because it made a down move and it looks like it's about to go down again, basically.
So I knew that this was distribution simply because I've seen the schematic so many times. But essentially, if you wanted to like debate it and you wanted to see like, okay, why is it? Well, in this position, it would have been redistribution, not distribution in itself. It would have been redistribution.
Oh, redistribution
It
because
would
it
have.
already
It would have.
happened.
Yeah. Well, not only that, but it would have been a stop in the downtrend, a pause in the downtrend, bust up, right, and then it would have been a this first drop, right? This secondary test, right? It would have gone up. It doesn't create a trading range per se, but it creates a change in structure. So I wouldn't have
Yeah.
known. So a lot of times people don't realize that distribution, accumulation, reaccumulation, reaccumulation, they have variations to their schematics. They all don't look like that one Wyckoff chart that you see.
Yeah.
They're not all going to look like that. There's many variations, and I'm working on making something called the theory of market hierarchy that I'm trying to put out and study as much as I can. I'm trying to backtest it so that I can see what is going on and like how to trade it more effectively. But essentially, you see that this is a variation of Wyckoff because it creates a very sloppy market range. Right here, it creates this very sloppy range. But not only does it create this sloppy range, you also end up seeing that this upthrust is mitigated and respected. So I wouldn't have jumped in until this upthrust is mitigated and respected, comes back down, and then comes back up and mitigates this.
That, yeah.
Now, once this would have been mitigated, I would have waited up until this position. But say I see this position on a lower time frame. I look back up on the weekly, I say, well, it's almost there. It's not quite there. Let me pull out my weekly fib and see what's up. It barely reached it, I think, or maybe not at all. Nope, didn't reach it. Not all the way. It reached the 75, which is, the alert where I usually place my alerts at the 75 so I can start, looking at it. But if at that position on lower time frames, I see distribution, I'm going to pull the trigger. Because by that point, there's no reason for you not to take that if that distribution schematic holds on the lower time frames.
Yeah.
No
so even on the lower time frames, you're going to see stuff like this.
Yeah.
Okay.
On lower time frames, on 3 minute, 5 minute, 1 minute.
Yeah, because I usually trade 5 minute.
Yeah, I remember that. You're going to see this. You're going to see schematics like these. Like that 3 minute schematic that we saw earlier, it doesn't look like distribution very much, but you see it mitigate itself and then react downward, then come back and mitigate its own extreme. When it mitigates its extreme, I would have fibbed that, gotten the entry, 3 pip stop, boom. Backtest it. I promise you, backtest it. I dare you.
Yeah.
And you will love it. Okay. So this is where I'm going to leave you guys off because I need to go to a meeting very quickly. But I will be on the phone. I will be texting you guys. And if you guys have any questions, Q, please, if you have a question, ask me. My DMs are open for every single one of you. And I want to make sure that you guys succeed. Okay. So I will catch you guys a little bit later because I have to go. But I will be online and answering questions.
I got you.
Okay.
Thanks for the help, man.
All right. Yeah, no problem.